Let's dive right into this explainer. Today, we're unpacking the debt secret and looking at literally the one number that separates financial freedom from total financial ruin. Turns out, the whole thing boils down to a single mathematical equation. Okay, think about this. Two people can take out the exact same loan at the exact same interest rate on the exact same day. But because they ask fundamentally different questions about that money, their outcomes couldn't be more opposed. One person ends up totally buried, obsessing over how to pay it off instantly, but the other, they're asking, hey, what is the spread and how many dollars can I control? Same exact loan, completely opposite results. The source material anchors on this incredibly fascinating idea. Debt is not the problem. Using it like you are poor is the problem. We really have to unlearn this deeply ingrained idea that debt is universally toxic. Think of it like a hammer, right? A hammer can build a beautiful house, or it can smash a window. It's entirely about how the tool is wielded. At its core, debt is simply rented money. That's it. You borrow a sum, you pay a fee for the time you hold on to it, and eventually you give it back. That interest rate you're charged, it's literally just your rent fee. So the only question that actually matters is whether the money you rented is out there earning you more than the rent costs. And this perfectly illustrates what we call the spread. If your rented money goes out into the market and earns 7%, but your interest, your rent fee, is only 4%, well, you just kept a 3% difference on money that was never even yours to begin with. That gap is the spread. And honestly, mastering the spread is the entire game of wealth building. Which brings us straight to the one-number formula. Your true return on your own cash equals the spread multiplied by your leverage. Basically, you take that percentage gap you just earned and you multiply it by how many borrowed dollars you've managed to stack on top of your own money. Let's look at a highly practical example to see how this builds, starting with trade credit. Almost every product-based business out there runs on this stuff. Imagine you want to sell pens. Instead of tying up your own hard-earned cash buying all that inventory up front, the manufacturers will often just give you the pens on what's called net 30 terms. They're essentially lending you the product for 30 days. You get the pens, sell them, collect the cash from your customers, and then pay the factory before the bill is even due. Now, because you sold the product before that 30-day bill was due, how much of your own cash was actually tied up in this deal? Exactly $0. You controlled an entire container of inventory with absolutely zero of your own money. And because you're dividing your profit by zero of your own dollars, your leverage and your return on investment are mathematically infinite. It's a pretty brilliant way to use terms to your advantage. Moving up the ladder of abstraction, real estate investors use this exact same concept every single day. So let's break down how they use debt to recycle their money step by step, straight from the source material. Imagine you buy a beat-up house for $500,000. You put $100,000 down, take out a $400,000 loan, and spend $50,000 fixing it up. So your total cash in is $150,000, right? Well, because you forced appreciation through those renovations, the house is now worth $700,000. So you refinance, get a new loan for $560,000, pay off that old debt, and walk away with $160,000 in cash. Really think about what just happened there. You put $150,000 of your own money in, and you just pulled $160,000 out. You recovered every single dollar of your initial investment plus an extra 10 grand. Once again, we arrive at that magic number, zero. You have literally zero of your own cash left in the deal, but you still own a $700,000 cash flowing asset, and you can now recycle your entire down payment into the next property for an infinite return. But let's be totally transparent. There's a major guardrail here. Your new loan is now $160,000 larger. At today's mortgage rates, that means a significantly higher monthly payment. So this entire strategy completely collapses if the rental income from your tenants doesn't comfortably cover that new, larger debt. Finding a property that actually cash flows, that's the real challenge. All right, now we're going to scale way up. Let's look at a massive, seemingly untouchable strategy used by the ultra-wealthy. You know when you read those headlines about billionaires paying almost nothing in income tax? It usually comes down to this. But here's the kicker. It's not some secret illegal trick. It's actually just 3 perfectly legal, ordinary rules stacked on top of each other. It's notoriously known as the buy, borrow, die method. Step 1. Buy and hold assets that go up in value. Because gains on paper aren't taxed, the golden rule is to never sell. Step 2. To fund their extravagant lifestyles, they borrow against those assets using a securities-backed line of credit. And finally, step 3. die. Under current tax law, assets passed to heirs get a stepped-up basis, which basically erases an entire lifetime of taxable gains. Let's look at the spread on this specific tax strategy. If they were to sell their stock, they could pay up to 23.8% in capital gains tax. Instead, they just go to a bank and borrow money against their portfolio at roughly 6% interest. They are intentionally renting money at 6% purely to avoid handing over nearly 24% to the IRS. The spread is massively in their favor, and their underlying assets just keep right on growing. And the societal impact of this stacked equation? It's pretty staggering. Because that final step, death, wipes the slate clean. The assets are inherited at their current market value, and that lifetime of growth is never taxed. The government actually estimates that this one specific mechanism costs them roughly $41 billion a year in uncollected tax revenue. Yeah, $41 billion. Okay, before we bring this back down to highly practical strategies you can use today, we definitely have to address the elephant in the room. What happens when this whole thing goes wrong? See, leverage multiplies the spread in both directions. If your collateral drops in value, the lender can issue what's called a margin call, forcing you to put up more cash instantly, or they just go ahead and sell your assets. Leverage can turn from a wealth-building tool into an absolute trap overnight. And the most dangerous trap of all is short selling, which is essentially borrowing in reverse. You borrow a share of stock, sell it right away, and basically just hope the price plummets so you can buy it back for cheap, return it to the lender, and pocket the difference. This perfectly illustrates why you have to be so careful. When you buy a stock normally, the absolute worst-case scenario is the company goes bankrupt and you lose your initial investment. But when you short a stock, there is literally no ceiling. If the price skyrockets, your losses climb infinitely because you eventually have to buy that share back at whatever price it reaches. That right there is a catastrophically negative spread. All right, let's step away from the danger zone and bring things safely back down to earth. I want to share a small-scale, highly accessible strategy from the source material that almost anyone watching this explainer can execute right now. It's built on the exact same principles as those billionaire lines of credit, just at an everyday level. It's called the 0% arbitrage. If you have debt on a credit card charging you 24% interest, you are just bleeding money. But if you move that debt to a balance transfer card offering 0% interest for 18 to 24 months for a small 3% upfront fee, you literally erase a 24% cost and replace it with a 3% cost. That is a massive, massive spread in your favor that no stock portfolio in the world can reliably match. And here is a number everyone actually has control over. Remember, the wealthy obsess over lowering their costs. And your credit score is the single biggest lever you have to lower the cost of renting money. Right now, the national average credit score is 715. Pushing your score from fair to excellent knocks whole percentage points off every single loan you will ever take. Mortgages, cars, business lines, the whole shebang. It's pure upside for your spread. So to put this into practice today, the source points to a few really simple steps. First, pull your credit score this week and actively work to fix the cost side of your equation. Second, go out and find a 0% balance transfer if you're carrying any high-interest balances. And finally, if you run a side hustle or small business, start negotiating trade credit. Use supplier terms and customer deposits so you're growing with zero of your own cash tied up. I want you to keep this final quote ingrained in your mind because it really captures the whole concept in one sentence. Debt is just rented money. The only question that ever mattered is whether what you do with it earns more than the rent. Getting this one mathematical inequality right completely transforms debt. It changes it from something that owns you into a highly calculated tool for growth. I'll leave you with this final question to think about today. Are you putting your rented money to work, or are you just paying the rent for someone else's wealth? Take some time to run the numbers on your own life. Find your spread. Thanks so much for joining me on this explainer, and we'll catch you next time.